Better System Trader, Episode 50.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 50, and I'm your host, Andrew Swanscott. I can't believe we've had 50 episodes already. I was just taking a look back at past episodes this week, and we've really had a lot of incredible guests and covered a wide range of topics. As traders, it's my belief that we really need to keep moving forward, learning new things, trying different ideas, getting fresh perspectives, always trying to improve. And I know I personally have been able to do a lot of that through this podcast, talking with the podcast guests, and I hope that you've also found some value in what we're doing here. Now, unfortunately, in this industry, there is a lot of rubbish out there, a lot of scams and dishonest people, but luckily, there is also a lot of people doing great stuff. They're trading successfully, they're doing innovative work, they're willing to share their approaches and ideas with others, and it's been my aim through this podcast to share more of that good stuff, get it out there and hopefully help people along the way. So if you do find value in this podcast, please show your support by sharing it with others. Tell all your trading buddies, follow along on social media, and please help us to get the message out there even more. Now, since this is a special episode, being episode 50, it's quite fitting that we do something special, and so Linda Raschke has come back again to help with this one. She was our guest on the previous episode, but we're not actually going to be talking about her trading at all. This episode, we're dedicating to the work of Nelson Freeburg. Nelson was the editor of Formula Research, which was a newsletter that developed systematic timing models for the stock, bond, and commodity markets. He was also a research consultant designing proprietary timing models for institutional money managers. And Nelson had been an active trader since 1980 and occasionally presenting his work to audiences around the world. So in this episode, Linda will be sharing some memories of Nelson. We'll be discussing his approach to model development and what we can learn by studying his work. But before we get started, let's hear a quick word from our sponsor. How would you like to copy the trading as some of the best traders around, automatically taking the same trades they take in their own personal accounts? Traders like Michael Cook, Larry Williams, John Ehlers, or even Linda Raschke, the guest on this podcast episode. Well, you can with worldcupadvisor.com. For more information, check the show notes page at bettersystemtrader.com/50. Trading futures and forex involves significant risk of loss and is not suitable for everyone. Now onto the chat with Linda. She has some great stuff to share with us today, so I hope you enjoy it. Hi Linda, welcome back to the show. It's great to have you here again.
Thank you, Andrew. Thank you for having me on again.
Now, this episode, we're going to do something really special because this episode we're actually dedicating to the work of Nelson Freeburg. Now, Nelson was a very well-respected person in the institutional community, but perhaps to the retail trader, his name may not be so well known. So I think we can all learn something from his work and his process. So I'm really excited to be presenting this with you today, Linda. Now, I know you and Nelson were very close friends for a long time. So can you tell us a little bit about Nelson, perhaps some of his background and how you came to meet?
Yeah, Nelson and I had a friendship for about 24 years, and we shared a love of the markets, modeling, people in the industry, fine food, American music and composers. We spoke together numerous times 2 decades ago. Many parts of the United States as well as overseas, and we were both members of the MTA, APTA, IFTA, which is the International Federation of Technical Analysis. So this is a friendship that developed over the years, but from the very beginning, he comped me on his Formula Research newsletter, and I'll describe the background of that. And in exchange, I comped him onto my little chat room forum that I had, and we were sort of opposite ends of the spectrum in terms of he believed in these longer-term timing models, and here I was doing much more short-term discretionary, and so we had many wonderful exchanges over the years, both theoretical, philosophical, and shared each other's work. Now, just to give you a little bit of background about Nelson, and by the way, I need to preface this, how this did come about. I contacted you because Nelson passed suddenly a year ago, May, and he did such fine work and was such a fine gentleman in the industry, but he never wrote a book. He never had a website that documented things. And all I had was this big pile of formula research letters from the years. And he was one of the very first early quants, in my opinion, that subscribed to the thesis that the methods are deficient if they rely on subjective judgment. And so I wanted to do a presentation in his honor of some of the things he contributed to the field of modeling and his philosophies. And so that's another way that this came about. Now, I'll jump and give a little bit of background on Nelson, because you wonder, how did a person that was going for his PhD in world politics end up in being a research for the markets? And originally, when he was developing his quantitative models as a graduate student, he was doing quantitative models on thermonuclear war. Okay, now this is many years ago. So he did have an exceptional math background, even though you wouldn't know it because his vocabulary consisted of many four-letter words. Mine, of course, are all one-syllable words. Okay, his were four-syllable words. And so he actually started off by building his own database, which was a big deal back in 1990. There wasn't access to the data that we have nowadays, or the ease of data. And so with his financial database, which went all the way back to the last century, he had an exceptionally powerful tool. And from this, he built a library of advanced trading strategies, as well as over time, he would take other people's work and try to find ways to improve on it. And so that's some of the things that I want to discuss as well. He was just the finest individual in that he was exceptionally humble and always giving credit to everybody else. He would, tout the work of Perry Kaufman, Martin Zweig, Ned Davis, Tom McClellan, John Hussman, Paul Merriman, Mark Boucher. Paul Tudor Jones was a huge fan of Nelson. Actually, the two of them went to school in Tennessee in their early years. So his graciousness in this industry and never taking credit for anything always struck me and set a really fine example. You would never hear him tout his own horn. So that's a good introduction. How's that, huh?
Yeah, that's really good. So you mentioned that he published a newsletter called Formula Research. What type of people actually read or consumed the information that he was publishing?
Well, it's kind of interesting. I know that Martin Zweig and Gerald Appel and Tudor Jones were some of his first clients, so a little bit more institutionalized based. But I also know he had clients in 27 countries. So it spread to be a pretty broad-based newsletter or research letter, if you will. It was reviewed in Stocks and Commodities magazine, though, so obviously your small niche trader had access to it, and I think he only charged $195 for a 1-year subscription, which was a huge bargain, considering that you still had to pay for postage back in those days and printing costs. So, it was widely accessible, and I would say that the last 8 years of Nelson's life, the frequency of his publishing the research letter dropped off dramatically. But his early work was extremely solid, and I think he took timing models from so many people. Very interesting timing models for stock market timing, gold timing, bond funds, a lot of switching models, seasonal work. He was one of the first to really, really exploit seasonal work, and a lot of what he did, even like holiday stuff. Nowadays, everybody, looks at these types of things, but Nelson was one of the first, in my opinion.
Okay, so if we just talk about this, the building of these models a little bit more, you mentioned a couple of examples, high level there, but what kind of components did he actually look at when building these models?
Well, again, I think what struck me most was that he would take other people's timing models, and they could use sentiment variables, market breadth variables, monetary variables, so many different types of data, something called a PMI. I'll give you some resources that you can Google and see some of his research letters. But he'd take these timing models, and then his whole focus was to limit risk. He would take these models and improve on them by finding ways to improve their risk-adjusted basis. So he was very good at adding filters, in my opinion. And some of the types of filters that he would include were either the use of some monetary variable, like short-term paper, the yield on short-term paper. And in particular, he would look at things like if these yields are above or below 50-period moving average, and also some type of trend filter. Now, if you want, I can jump right to the meat of the matter and give you an example of a model that I still look at nowadays.
Okay.
And then that might serve as a good basis. This is actually a very simple model. Mm-hmm. It's a model that we actually have on TradeStation, and Nigel, when he worked for me, programmed this on TradeStation. And it's one of those things that you can easily tweak as well. So keep in mind that this particular model was developed, 15 years ago at least. But it'll give you an idea of the creativity that Nelson had. This model he called the Russell growth versus value, and it was a model for simply assessing whether you should be in the market or out of the market. Pretty simple and straightforward. The first variable was using the Russell 2000 growth and the Russell 2000 value. What he did is he would take a 5, 15, 25, and 35 period look back, average the 4 of those readings. Now, once growth, the ROC, the rate of change readings of growth, closed above value for 2 bars, one crosses the other, that was condition 1 that had to be met. You see, so it's basically a relative strength type of model, saying that when the growth is outperforming the value, you need to be long. The other 2 filters are the OEX divided by the SPX must cross above its 50-period simple moving average, and the NASDAQ divided by the SPX must be above its 50-day moving average. So when all three of those conditions are positive, you are long in the market. And it takes all three of them to turn negative for you to go into cash. So a clever little twist looking at momentum, okay, in a way by the Russell 2000 growth versus the Russell 2000 value. And it doesn't give many signals. That's something interesting. In a lot of these timing models, they might just give anywhere from 1 to 2 signals a year, sometimes even if that. So I will give people another way to see on the internet. If you simply Google Formula Research, which is the name of his letter, and Tom McClellan, Formula Research Tom McClellan. In 2 of his issues, he reviewed the work of Tom McClellan, and Tom was gracious enough to include both issues on a PDF that you can download for yourself. So voila. I think there's a copy, I think one of them discusses a gold future timing model. And Nelson had tested it back to 1950. And what's interesting is that he made a comment that Tom would never use a simple formula like this in isolation, but the theoretical results are instructive. So it's just opening up your mind to different things that you can include, or different things that money managers or more institutional people might look at. The ultimate example of this, of course, is Ned Davis. You know, Ned just modeled everything under the sun. He used to compile a quarterly book of like 3,000 of these models, and you know, the managers could sift through them and you know, see what struck them most. So, but again, you know, the point is that we had some interesting discussions over time on whether you do out-of-sample testing, how far back you go, and the pros and the cons of both of them. Because I was doing a different type of modeling, mostly price-based work, and very technical, I could get huge sample sizes. Whereas Nelson had this more holistic type of approach that included variables, you know, short-term interest rates, you know, all sorts of longer-term trend things, you know, sentiment readings, market breadth things, and therefore he would end up with a much, much smaller sample size. And so we used to discuss whether his work would hold up, you know, whether it could be considered to be durable and robust when you had such a small sample size. Yeah. But Nelson was really big on common sense counts a lot, despite the lower sample size. So I think it's up for the listener to judge for themselves. And one thing that they can do is look at the gold timing model that was presented in the Formula Research that was featured by Tom McClellan. Yep. Because interestingly enough, that gold timing model was produced in 2003. Now, I know the initial testing for this gold timing model went back to 1950, okay? So here it is, 2003, and then the next 10 years, you enter the most unique, incredible monetary environment, you know, where there were no previous examples of this type of global mass money printing. Yep. And I just challenge the listener to replicate that model for themselves, because all the variables are disclosed right there. You replicate it for yourself and then see how it would have held up over time.
Yeah, I've also actually read that Formula Research article on the McClellan website, and there's an application for the gold timing model as a short-term trading as well. So I think typically when you think about timing models, they're they're longer term, but I think if you look at the principles behind them, and perhaps there's applications in other types of trading timeframes as well.
Absolutely. Absolutely. All of this, by looking at the methods that other people do, how they went about their testing or their modeling, you're just always educating yourself. It's like you might be an English student, but if you had to go take a history class or a class on political philosophy or anything like that, it's just going to increase your, quote, well-roundedness.
Mm-hmm.
And you might just come across one or two things that would give you pause. For example, when you did that interview with me last week, one of the questions that came up was about out-of-sample testing. If you should do walk forward and pre-sample testing and so forth, and Nelson actually answered that question. He was very good about arguing all these theoretical pros and cons. And he said, on one hand, you don't want to extrapolate a trend that may no longer be there. So, for example, if you had developed a model, do you want to include data from the 1930s, from the 1940s to the 1950s, etc.? All right. So, but what if there was some interesting, unique trend during that period, but now is that going to influence your data currently where this price behavior no longer exists? But on the other hand, you do need to see that the system worked in all sorts of price behaviors, and could it have survived, that awful 1929 to 1932 period, or the recent downturn that we had. And these things were important to Nelson, because his number one driving force, besides just trying to get rid of all subjectivity, was ways to minimize risk. And, a lot of the questions that I received last week were people, asking about trend following methods. Was there a filter, a way to, know when to use them, when not to use them, and so forth, to which I said, no, there is no way. You're trying to capture an outlier. But, Nelson's research on this is very, very robust, and he's any trend following system, that's going to produce 15%, returns over time is going to have a 50% drawdown, at least. At least. So the data, you can take any 10-year rolling period and see that it will have a positive expectation, but crazy huge inherent drawdowns. And Nelson said it himself. You'll achieve fairly consistent profits over time, but at a huge cost of this irreducibly high amount of drawdown. So, his number one driving goal was, how do we reduce that drawdown? Because once you can reduce that drawdown in the system, and that might be reduced by having a model that switches you into cash, all right? But once you can reduce that drawdown, then you can increase the leverage. And boy, oh boy, he was a master of figuring out ways to turn 10,000 into 100 million simply by reducing the drawdown and increasing the leverage.
Okay, and so did he only work on long-only models?
No, he did currency models, he did bond models, he did gold models. I particularly liked his relative strength work, with the ETF switching. I think he was one of the first to do that more aggressively. But again, it might have been, under the guise of taking somebody else's work and improving it.
So you mentioned that he had data going back to last century, and he often did tests back to the 50s or the 30s. It must have been quite difficult getting some of that data, and perhaps the accuracy of that data may come into question. So what kind of lengths did he go to get all this type of information for his database?
Now that I can't answer, but I can tell you that all that Nelson did was this formula research letter. So with this type of research, and model improvement and developing, it consumed a fair degree of time. He always said he wanted to manage money, but I never saw him do it or even get partway there. And I think it was just because he was so consumed by his own research and publishing this letter.
So we're going to take a really short break here for a message from our sponsor, but hold on tight because right after that, Linda is going to share the biggest strengths of Nelson's work and how we can actually apply that to our own situation. So keep listening. How would you like to copy the trades of a veteran hedge fund trader with 35 years of market experience? WorldCupAdvisor.com lets you do exactly that. With the launch of Linda Raschke's new stock index futures and short-term diversified leader-follower auto trade programs, you can now make the same trades that Linda makes in her own accounts. That's right, Linda has her own money on the line, right along with her subscribers on every trade she makes in her accounts. World Cup Advisor identifies futures and forex trade leaders through rigorous screening, including live trade evaluation in the World Cup Trading Championship competition, and enables subscribers to mirror their trading buy for buy and sell for sell. As a subscriber, if your fill price is not equal to or better than your lead trader's fill price on any trade, that trade is commission-free from your authorized broker. There are more than a dozen futures and forex programs to choose from, and you can view complete actual performance data before subscribing. To learn more, check the show notes page at bettersystemtrader.com/50. Trading futures and forex involves significant risk of loss and is not suitable for everyone. Now on to the chat with Linda. Okay. So in a trading or research kind of context, what do you think was Nelson's biggest strength?
I think it was a genius at creating monetary filters, which is really interesting because nowadays, see, here we are. I'd be curious as to how many of these models actually hold up these last 8 years in the current monetary environments, which we've never had before. And that's one of the problems with, certain types of modeling. But he'd look at the spread between the discordant rate and the yield on 90-day treasury bills, But again, now all of a sudden this might be a moot issue with the Fed actions that we've had. He loved mutual fund switching models that would also include an option to go into cash or T-bills. That was a big one of his. I would say that all of the most successful models did have some type of trend following component. Some indicator or variable needed to be above its 200-day moving average or, that type of variable or filter in there. And he also was big on voting systems, and this is something that perhaps the type of research that people do for the real technical systems never consider. But a voting system is, you have maybe 6 components, and if 4 of the 6 are green, then the model goes long, that type of thing. So that was another type of approach you could do to the modeling.
Okay. Now, by studying his work, what do you think, what can we learn? And I don't mean just the obvious stuff like how his models work, but at a deeper kind of level, is there some underlying philosophy or attitude or approach that we can learn from and apply ourselves?
Yeah, I think people, everybody likes to optimize, the results. I mean, it's a temptation to go there. And Nelson felt very strongly that anything that was optimized was not going to hold up or make money over time. But even deeper, I think people, when they're creating their models, they need to take a much deeper look at some of the things that affect the risk, number of consecutive drawdowns, largest losers, how long it takes for the model to get back to, its high equity point, these types of things. And, Nelson, I think, was way ahead of his time in really emphasizing that. But, of course, people like the glory. Oh, just tell me how to take $10,000 to, $10 million. And he could show you how to do that. But it was very clever on the ways that he minimized risk. And he felt very strongly about that. So, again, in people's own timing, just don't sit there and say, oh, gee, what was the best profit factor, or the largest average win, or, even worse, how, which set of parameters made the most money. It's, I think that's completely barking up the wrong tree, but instead, you need to look at these other types of measurements to see where the Achilles heel could be in that system.
Yeah, that's a good takeaway. So what about you personally? What was the biggest impact Nelson had on your own work?
I don't think it was necessarily the content of the letters that made an impact on me. I think it was his own enthusiasm for the way that he could extrapolate these outrageous results, And like I remember, there's a story where he took his 5 all-time favorite stock market timing models. All right. God knows, I don't have no idea how many he had. And then he combined his 5 favorite stock market timing models into a structured whole. So he had a composite model that would outperform any single component. He was the master of that. Okay. So then what he did is he gave a private seminar for Paul Tudor Jones and some of his key traders. And the Tudor group was amazed, when he showed them how to turn $10,000 into 65 billion. And that's true. He actually did that, with these composite models and so forth. Of course, that was obviously over a period of 3 or 4 decades, and the compounding, the power of the compounding, and so forth and so forth. But he was just so gleeful, in like a little kid, like, look, I've got the Holy Grail right here, by combining these models and stuff. So, on a modern day take, you could say, let's combine, if you're doing mechanical systems, and this is along the lines of what we did when we ran a portfolio of these things, we would have both for example, a trend following and a mean reverting, or a volatility breakout system that would trade as an overlay, as a money management function, against a longer term system. So, for example, you might have a system that would have an average holding time of, say, 14 days or, say, 20 days. But if you had a volatility breakout system that would take the trades in the opposite direction, for example, when there was a long liquidation, flush, or a little short squeeze, basically what that does is it takes you out of your position. You're flat by nature of the counter trend mean reversion function. And that might only have a holding period of, say, 1.5 days. And then when it closes out its position, you are back in with the original longer term position. So that's on a simplified basis, but obviously you can see the room for many, many overlays along this line.
Yeah. So you've already kind of touched on this a little bit by mentioning the Google search and the links to some old formula research newsletters, which I'll add to the show notes page so people can find them easily. But if people wanted to find out more of Nelson's work, is there any other ways that they can do that?
Sadly, no. That's why I just felt compelled to at least present the tip of an iceberg, just a few simple points. And hopefully that'll also, give a motivation to anybody that's out there that does individual research or unique research. They don't have to give away the secrets to their models, but I think there's more room for theoretical debate, amongst the community, the quant community, where people don't necessarily have to reveal anything proprietary, but yet there's enough people out there that share their work that it sort of ends up keeping a little documentation from, a couple years to a couple years to a couple years. There's members of the quant community that have blogs that are gracious enough just to share their take on different things. And that's a resource for all your audio listeners, I don't know if you have a compilation of different quant blogs on your site, but, so it gives little windows of insight as to the way that people go about their work without necessarily having to disclose anything proprietary. And hopefully the listener understands that there's not just one authority out there. And, I have to say that many times when I was doing a lot of my initial testing with Steve Moore, I get some results back. I'm like, wow, this is fabulous. This is just so consistent, and then a week later, delving into the data, I'm like, geez, there's a flaw here,
Yeah.
That happened many times. These results are not quite as stellar as I thought they were. And so I've seen others make that mistake too. In their exuberance, they might disclose something, and later on they go back and find that it wasn't quite as they thought, And then there's people out there that put out interesting models and conveniently neglect to include one or two key variables, you see? So it's always a caveat emptor, but back to the fact that everybody really needs to go do their own testing, and if you do find something, see if you can improve upon it or find a way to make it your own. Very important in research.
So is there anybody out there that's currently doing similar type of work that Nelson has done?
I think it's very cool that everybody's latched on to, these sentiment variables in numerous ways, shapes, and forms. All the little biases, the pre-holiday, end of the month, beginning of the new month tendencies, and people need to be aware of that. This is not anything new at this point. I think Victor Niederhofer always used to preach, that like once something's out there in the marketplace, and it's been getting exploited, it can become a little bit trickier, that the half-lives are shorter than ever. But some of these things still hold up. Jay Capel does wonderful work, and he publishes a blog, and he puts out some of these funny little things along this line. Tom McClellan does interesting work, with taking variables and finding the correlations if you set it 10 months forward, 10 months back. And he publishes, I think once a week he sends something out there for free. So Tom McClellan, Jay Capel, I know there's a number of people that do the sentiment and the little quantitative patterns. Okay, this worked for the last 10 years, Be really careful when you see this published research where the sample size is like under 20. And Steve Moore always preached this, that if you have something that worked 17 out of 20 years, say, for example, on a walk-forward basis, it's only going to produce 65%, right around there. And that's just because you don't have a sample size that's large enough to get high enough confidence factor. But it still is entertaining to watch, and it might just be one little variable that gives you a nudge to trade a signal with your own system with added confidence.
So on sample size, what do you think is a relevant level to get some confidence?
Well, unfortunately, it really depends on what you're testing. And as Nelson would aptly point out, the types of variables that he used, you might not get much more than, 20 or 30, So for me, when you're dealing with short-term technical type of data, and it doesn't even have to be short-term, but just pure price-based data, if you will, I found it at a minimum, I need 300 at a minimum, and even that's not quite adequate.
Well, 300 over what type of time frame are we talking there?
Well, again, that's shorter term data, and it's going to have to be put into a context.
Yeah. All right. Well, thank you very much, Linda, for bringing some of Nelson's work to us today. Is there anything else that you'd like to add before we wrap up?
No, I just I would encourage everybody, just Google Nelson Freeburg or Google Formula Research. There's all kinds of little bits and pieces out there. I think there's an interview with Larry Connors, a 2-part interview with Larry Connors that he did. I know INO, I think he's got some old webinars that he did. You might be able to find some PowerPoint presentations. The last time I saw him give a presentation was over in London in I think 2013. That might be, or 2012. That might be on the website for the MTA, the London MTA, Market Technicians Association. It's amazing once you start playing around with Google, all the kinds of relevant stuff that you can dig up. But this was, again, it was a tribute to Nelson. He passed very suddenly. None of his stuff was really documented other than the formula research. He didn't put anything on a website, didn't put anything on a book, and that's just a lesson out there to people that feel they have something significant. Find a way you can include it in your will, if you will. I feel like myself, I've done enough YouTube or webinars for assorted organizations at this point. I really don't have anything new to say. But again, I just want to do a tribute to a very, very fine, ethical individual in this industry who did so much to promote other people and other people's works. So thank you all for listening and honoring Nelson Freeburg with this podcast.
Thanks, Linda. As you mentioned, Nelson was well respected amongst his peers and published some great work. So it really was an honour to dedicate this podcast episode to him. And thank you so much for sharing that stuff with us today.
Thank you, Andrew.
All the best. Bye. Okay, so a big thanks to Linda for sharing with us today. Now, as Linda mentioned, there is some information about Nelson and his work scattered around the internet. It's not much, but I've done a bit of searching and have included some links to the stuff we talked about today and some additional content that I found. And I've put that on the show notes page. So if you want more info, I encourage you to check that out at bettersystemtrader.com/50. Also, if you have any other links to Nelson's work, please let me know. And I'm happy to share that on the website too. So I hope you found some value in the chat with Linda, discussing Nelson and his approach to modelling, and I look forward to catching you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.